Hey folks, it's Rob Flux here with another Sunday session, and this week is a special one. It is one that we do on a semi-regular basis. It's called Over the Horizon, and this is where I try to get my take on where I see the property market actually going and trying to impart that knowledge with you. Now, clearly, whenever I'm talking about a topic like this, over and above any other topic that we actually do, I have to give a disclaimer. I'm not a property economist. I'm not an accountant. I'm not a solicitor. I'm not a financial planner, and none of this should be taken as giving you specific or general advice. Rather, this is my view on how I'm reading the market, and hopefully by me imparting my wisdom on you, it will inform you on how you can actually do the same. Now, this is an extract out of what was a full-day event that we ran last weekend called the Property Development Summit, where some of you may have actually seen, I guess, this market update in its full extent. But because of the popularity of that event and the number of people that actually reached out to me and said, hey, Rob, we'd really, really like to have, be able to review the content and the like. I thought I'd carve it out again and give it to you as I see it, folks. So now the property market, obviously there's lots going on in the market at the moment with regards to inflation and interest rates going up and all those sorts of things. And so there's a lot of the media talking about doom and gloom in the market. But as property developers, what we need to be doing is not just looking at what's happening in the market today, but rather we need to be projecting what's going to happen in the market as we are exiting our deal. Now, for some of us, our projects will take 6 months, 12 months, 18, 2 years, 3 years, in fact, for some of our projects to come out. So the market that we're in right now and the market that we actually exit our stock in may not be the same thing. So it's super important for us that we actually know how to actually predict the future. Now, in order to do that, we need a crystal ball, and my crystal ball is a little bit fuzzy, but this is not science, but rather a black art. So what we need to do is look at a lot of things that actually are driving the market, and that will give us the insights in how and what to do. Now, the first things first, when the media and any property commentators are actually talking about the market, they tend to be talking about a thing called a property indicator. Now, an indicator is something that has already happened. Okay, so it's in the past. So because of the fact that it's in the past, it means that so things like auction clearance rates, things like our median house prices, things like days on market, they're things that have happened. Now, because they have happened, I guess the indication, or so the thought bubble is, well, it actually happened yesterday. Auction clearance rates happened yesterday, so therefore it must be current market activity. But in reality, it's a lagging indicator. It's actually capturing what the market was thinking. I'm going to say approximately 4 months prior. And because it takes time to think about, do I want to put this on market? Then you have to go and research who is the agent that I want to go listing it to. You've got to prepare your property for going to market. You've got to put the marketing package together. You've got to select your agent. You've got to, go out, do open homes, then sign a contract. Then it will actually, then go and settle. So when you see a settlement happen, then it's typically a reflection of what was happening 4 months ago. And because of that, an indicator can be quite misleading. And unfortunately, this is what most of the media actually talk about, is these indicators that appear on the surface to be current events, but in reality, it's a reflection of what's happened, which means that we've already missed it. If it's actually talking that way, if things are going backwards, it actually, the event happened quite some time ago. What we want to do is we want to start to think about, how do we start to predict what's going to happen next? Now, in order to do that, we look at a whole bunch of different things completely. Now, so there's indicators, then there's indices, and then there's drivers. So an indicator, as I've just talked about, goes backwards. An indice is where there are, I guess, a number of market commentators who try to simplify things for us, because most of us don't have the time to actually go and look at all the research and look at all the graphs and all that sort of stuff. So an indice, it tends to be something that has amassed a whole bunch of information into one form. And quite often it's an infographic or something along those lines, such as the property clock, the Herentide White property clock, or the CoreLogic hedonics index on the market. So those sorts of things are giving us, I guess, a collation of a whole bunch of things into one spot. Now, the challenge with that is, well, it's a lag on a lag. So when we're starting to look at things like the property clock and we're trying to make decisions on that, remember, it took them up to 4 months to get to the indicator, and then a month or so afterwards for the property clock to actually be generated. So quite often we're very, very way behind, and it's not giving us an indication of what's happening in our current local geographic market, but rather as a region per se. And then there's the true drivers. So the true drivers are what helps us to actually create what is causing the market to move in the first place. So these are the things that move the dial. And it is these things that I want to walk you through today, that if you can actually start to understand them, then they're going to give you all of the insights that you need in order to move, I guess, to predict what's going to happen in your local market. Now, noting that whenever we talk about our local market, we need to keep in mind a couple of things. There are state, regional, capital cities, suburbs, then there's dwelling types, houses, units, townhouses, those sorts of things. So there's markets within markets within markets. So we don't want to be very generic. We don't want to have this big, broad view, but rather we want to narrow it all the way down to say what is actually happening in my city, in my suburb, with the exact strategy that I want to do. What's happening with that? Now, when you start to do that, what you might find is, look, there's an oversupply of one kind of stock and an undersupply of another kind of stock, which means that one is going to shoot up and the other one's going to shoot down. Now, you might go 2 suburbs over and it might be completely different. So you want to really start to take some really clear views on, hey, if I'm going to narrow down my focus on exactly what I'm going to do, I need to understand those markets within markets and what is actually turning me on. Now, let's talk about some of these market indicators. Okay, so the indicators, as I said, are the ones going backwards. They come into 4 basic categories. So stock availability, right? So that is the listing volumes, so the sales volumes, the amount of stock on market. They're giving us what's actually happening in the market today. We can actually see right this very second the amount of activity that's actually happening on places like Domain, realestate.com, and Homely, right? So they're the 3 leading sales portals. We can see exactly what's happening on those. Now, they're not the only indicators, okay? So if we're looking specifically for investment stock, then we might care about things like vacancy rates. We might care about rental yields as well. If we're talking about either of those 2, there's stock turnovers. So there's days on market, there's auction clearance rates, there's vendor discount rates. And then when we sum all of those up, then there's I guess, just the feel and the vibe of the market. It's called the market sentiment. So you've got business confidence, which is businesses' confidence levels in actually investing in expanding their business, taking on new staff, building new factories, taking on new workshops, all those sorts of things. And then there's consumer confidence. That is the people working in the businesses. Do they feel confident in their job? Do they feel confident in the economy? Are they I guess, worried about where the market is actually going? Those sorts of things. So when you start to put all of those together, you get a little bit of a view of what has happened, okay, as an indicator, what has happened, right? Which gives you a vibe, which you can then use to inform when you start to look at your drivers to say what is about to happen, okay? So when you start to see those things together, what I want you to start to do is I want you to do this 1-2 combo. Look at the drivers and say, where do I think the market is going? Keep a note of it. And then months later, I want you to go back and go, remember, because the indicators are lagging, months later, I want you to then go, was I right? Can I see the evidence of what it is that I was actually talking about? Can I see the movements that I were actually talking about? Now, if we're looking at just the indicators because we don't have the time to look at all the drivers and we just want to have a little bit of a view on the market, okay, there are 2 indicators that are a very quick hack on how to read the market right here, right now. So firstly, there's the sales volumes, as in how many sales are actually occurring at the time, and there's listing volumes. So how many properties are actually going on the market at any one point in time. Now, when we start to look at these, we want to look at them over a period of time and as a trend. Okay, so we're not looking for a particular moment in time, but rather we're looking at how that has actually changed over the last little period. So when we start to see the sales volumes and the listing volumes, if we see both of those going up, okay, if we see both of those going up, then the amount of stock coming on market is high, the amount of people buying the property is high. Clearly, the property market is confident. If we see both of them going down, then clearly nobody's putting much property on the market and nobody's buying the property either, so the market is clearly concerned. Those two are pretty obvious, but it's where they are crisscrossing that it starts to become really, really interesting. So when you start to see that the listing volumes go up, so if a listing volume goes up, that means lots of people are wanting to put their properties on the market, but the sales volumes are going down. When you start to see that, that's where you start to see, I guess, a crashing market. So people are trying to panic and they're trying to push their property onto the market right now. I need to get my sale happening right here, right now. And the number of people actually turning up in order to buy those properties are like tumbleweeds, okay? Now, the opposite is true if the crisscross goes the other way. So if the listing volumes is going down and the sales volumes are going up, that means that we're in a booming market. And if we start to think about that, lots of people are wanting to buy property. And so they're rushing in, and as soon as it comes onto the market, they're snapping it up. But the people that have properties, because of the fact that the market is going up, they're wanting to hold on to it and they want to ride the market as long as humanly possible until it actually gets to the top. So when you start to see those crisscrosses, that's where it actually starts to get interesting. Now, based on that, let's have a look at some graphs that are going to turn on some graphs here for you. Hopefully you can see that. Okay, so this is the Sydney listings volumes. This is courtesy of SQM Research. And what we can see is very clearly there's an upwards trend with regards to, I guess, where the listing volumes are going for Sydney. If we start to look at our next one, we can actually see Melbourne very similarly, upward trend. And lastly, we can see Brisbane listings also upward trend. So those are super interesting, but that's just the listing volumes. What if we then started to look at the sales volumes? Okay, so if we look at the sales volumes, you can see previously we had an upward trend, but it has now turned and now started to do the downward trend. Now, as we start to look at the markets over here, and as we read the commentary as well, you can see Sydney's gone backwards a hell of a lot. Brisbane and Melbourne have gone backwards relative, I guess, to where they were last year. So the trend is going backwards, but they haven't yet gone backwards into the slump that that Sydney is seeing, where Sydney's actually going on a true backwards actually trend. So when you start to see that, that is the exact crisscross that I was talking about before. That is telling us that we are very much in a concerned market. In a crashing market. Now, that's what the media are starting to comment on. So we can see the evidence that those things are actually there. But as I said, this is talking about, I guess, the sentiment of the market that was 4 months ago, and we're only starting to measure it now. So we start to go, well, what could we or should we be doing to make sure that we're actually predicting that? Okay. Now, because of that, we want to start to think about, well, they're not the things that we want to look at as our only source of truth, because it's too late. That's like getting in the back of the Uber or the back of the taxi and have the taxi driver tell you what is actually happening in the property market. The moment they're telling you what's happening, you've missed it completely, okay? We want to be there at the point where it's actually happening. Now, I also mentioned that there are other things called indices. So an indice is something like the Heron Todd White property clock, and we can actually see in this particular instance, we've got Sydney, we've got Melbourne, I guess at this 3 o'clock mark, we've got Gold Coast, we've got Brisbane still all the way up here at the peak of the market, apparently. But remember I said it takes them a while to collate this information, and it's based on the all of the previous history of everything else. So quite often the lag on this is a little bit behind. So I would always go, look, if I was to err on something, it's more likely to be a little bit further down the process. So we can actually see things are sliding on the downwards market on the way to the bottom, and we've probably missed the peak of the market for everybody else. So they're the indicators and the indices that are actually sitting out there at the moment, folks. But if we start to look at business confidence is up. We're in, I guess, some of the best times that we've had for a while from an economic perspective, with regards to, I guess, the GDP of the country, with regards to I guess how business has recovered from COVID and a whole bunch of other things like that. But consumer confidence is exactly opposite. Consumer confidence is one of the lowest we've got for quite some time. As a matter of fact, it's approaching the lows that we actually had. And I'm going to show this. We're actually approaching the lows that we actually had during the COVID times. We're actually broken out of the normal range that we actually operate in. That is telling us that the market is concerned about how and where we're going. Now, the market is, I guess, fed on, I guess, emotion, and it's fed very much by the hype that comes from the media. So as the media starts to agitate them, then the fear mongering starts to happen, and like sheep, everyone starts to run off the side of the cliff. So we can actually start to see right now that they're running right now. They haven't hit the cliff yet, but we can see that they're actually running, and they're very concerned about where that's actually going to go. And rightly so, because lots of things have actually happened. We've had I guess 4 interest rate rises in a row, and the RBA is predicting a couple more coming down the pipeline. So that said, let's have a look at, I guess, some drivers. So the market drivers come into 4 key categories. I'm going to show these 4 key categories here. So the 4 key categories. So we've got government incentives. So that is major infrastructure projects, federal government spending, state government spending, local government spending, any cash incentives and bonuses that are actually sitting out there. We've also got population growth. So births, deaths, and marriages, intrastate migration, interstate migration, international migration. We've also got supply and demand. So development approvals, building approvals, construction, industry health, finance approvals. So development approvals tell us, I guess, what potential we've actually got for supply. Building approvals tell us whether that potential is starting to be realized and actually getting to the point of almost being constructed. And the finance approval is at the point where, well, it's actually getting built now. Plus the construction industry health itself is actually then telling us whether or not people actually are wanting to buy stock, which at the moment, as we know, cost of materials, cost of labor is quite high. So they can and will be quite challenging for the next little while. And then lastly is our purchasing power. So purchasing power is unemployment rates, which we all know are at record lows at the moment. Interest rates, which are going up, our household income and consumption. So as soon as people are concerned, they start to hold on to their cash rather than spending it. They start to save it. And then the fiscal policy is what's driven by the RBA and APRA. So those 16 drivers are what are the drivers that are actually going to tell you what's actually happening in the market in the future. Okay, so what you need to do is you need to start to do a whole bunch of homework, a whole bunch of research to go, okay, how much is actually being spent on government jobs? How much is actually being spent on cash incentives in actually moving us forward? How much is being spent, what's happening with regards to our population growth rates and things like that? Is there an oversupply or an undersupply of product in the market right now? And if there is, I guess, an opportunity to purchase based on that supply and demand, can we actually afford it? They're really the 4 elements and the 4 stages in the process. Now that takes a lot. Now I'm not going to go through every single slide that I went through on the weekend, but I will talk about it as a little bit of a trend. And because of the fact that this is a little bit of a black art, then what we can't do is just go, there's an actual scorecard that we actually get. So what I want you to do is start to think about the concept of what is called a headwind and a tailwind. So a headwind is imagine something that is working against, as you're walking down the street, a bit of wind is pushing against your face. It makes it harder and harder for you to actually walk forward. That's a headwind. Now, a tailwind would be if the wind is behind you and it's hitting your back and actually pushing you forward. So when we look at each of those 16 different elements, we want to work out, look, is this actually helping the market or hindering the market? And when we start to look at all of them as a collective unit, rather than on individual merits and individual basis, if we start to look in a collective unit, we can start to see what's actually happening with regards to, look, have we got the potential to actually turn our market around? And if so, when do we think that potential is actually going to kick in? Okay, now, the simple way to actually do that is basically with a couple of tick boxes. I'm just going to show you kind of how I kind of track it. So you can see here, I've kind of mapped each of the different elements. Now I've gone back 24 months, 12 months, and now these are how I do these on a fairly regular basis. And I'm going to try and go through, I guess, the next 6 months and 12 months. But what we can see, I did these predicting in the future way back, and I've just kept these on record. So you can actually see that I was predicting the fact that our market would be dropping, strangely, which it did do in the COVID time period, because everything was actually a headwind going against us. I also predicted the fact that we were going to have the boom before the boom actually happened, which we did have clearly. I've also predicted previously that that the market was actually going to soften, which it has done. So what I'm going to try and do is actually then talk to you about, well, have we got headwinds or tailwinds in each of these areas moving forward? So where do we think the market is actually going to go? Now, there's a heck of a lot of research that goes into this, folks, and I'm not going to share all the links. I'm not going to share every single slide, because honestly, it is a huge amount. And if you came to my property development summit last weekend, you would have seen it actually took me nearly 220 hours to collate that and 9 hours to present it. So I'm not going to go through all of that today, given our timelines, but I will talk to each of them at a very, very high level. So from a government incentives project, so infrastructure projects that are actually being spent around the grounds. Now, New South Wales, Victoria, and Queensland are spending billions and billions of dollars on infrastructure projects right now. So New South Wales is spending somewhere in the vicinity of $120 billion in infrastructure projects, largely, I guess, big transport projects like the metro and a few other things like that I'll go into in a sec. Victoria is similarly spending somewhere around the $90 to $100 billion on infrastructure projects at the moment. Queensland's spending somewhere in the vicinity of $35 billion. So all of those things, what they're doing is it's the government printing money in order to create infrastructure projects which create jobs. So as we are doing all of these infrastructure projects, it does two things. One, creates the job, which then starts to activate the community. So what happens is, as somebody is working on a major project in the area, that person, A, has a wage, B, they need to have somewhere to have lunch. They need to have somewhere to knock off for the end of the day. They need to go to the pub, the club, the movies, all those sorts of things. Those people start to congregate and live and work in those areas, which then means that those people are spending money in those areas. They go to the shops, they buy food, they buy clothing, those sorts of things, which then starts to activate all of the businesses in and around where these projects are. Now, the state governments are doing this very, very deliberately, because what they know is, look, we're going to have these massive population growths. And if we don't start to herd people to where we want them to go, then it's going to be super expensive for them to build the infrastructure that they need. So what they try to do is they try to build the infrastructure first, which herds the cats so that everybody comes to where the infrastructure is, rather than this giant urban sprawl. So they're designing the cities of the future 20 and 30 years in advance. And so when you're seeing these major infrastructure projects, it is them activating areas and starting to turn them on. So in some instances, they activate it after the people have moved there. In most instances, they try to be predictive and they actually start to activate it earlier. And a lot of that is actually happening. Now, as we came out of COVID, because of the fact that we went into, I guess, a fairly limited economic downturn. So it was a short-term downturn, but it was artificially created. The government had to basically recover the economy as quick as humanly possible. And the first thing they did was turn on all these infrastructure projects that have been sitting in the pipeline for some time. Because they had already designed 20 and 30 years in advance, they said, well, let's just turn that project on. It's about time. We're going to need it. Let's just go. Now, these projects take anywhere from 2 to 10 years to roll out. So this is not just, hey, this one off. This is something that's going to continue for many, many years as these projects start to roll out. So if you are in New South Wales, if you're in Victoria, if you're in Queensland, there are jobs being created at the wazoo with billions and billions of dollars being spent. Now, all of that is fantastic news when you start to look at what that means for the labor market. What it means is that there's going to be a huge amount of jobs for the next 5 years or so where people are going to be employed. There's going to be guaranteed money, because government money is guaranteed money, to actually go and spend in the area. And what they call trickle-down economics, as those people start to spend money in the areas, it's going to keep the economy vibrant in those areas and activate those zones. So if you are anywhere in and around those infrastructure projects, folks, that is a good sign for you. That is a tailwind that is pushing you forward. Infrastructure projects that are near you is a tailwind that's pushing you forward. If there is no infrastructure projects in your area, that is a headwind, because you've got nothing to actually activate the area. So right now, major tailwinds in all three of those states, okay? And in looking at the trend lines as to how and where they're going, we've got a good 5 years worth of spend that's actually going to happen on these. So some of the major projects that are happening in around this: the WestConnex projects, $16 billion. Sydney Metro, $12 billion. Melbourne Metro Tunnel, $11 billion. The Melbourne to Brisbane Inland Rail, $9.3 billion. The Bruce Highway upgrade, $8.5 billion. The Westgate Tunnel, $6.8 billion. Now, I want you to pick a trend that's actually happening here. All of these are transport, okay? So the three things that governments tend to spend major infrastructure projects on: transport, hospitals, schools, universities, okay? So when we start to see those sorts of spends, they are activating the area. So what they're doing is they're trying to activate the area to say, we want people to be able to get to and from work as quick as humanly possible, and we're going to make these major projects, make it super easy for them to actually do. So that's infrastructure projects. Now, government grants side of things, if we look at that, then there is no current government grants that are activating anything in the construction industry at all. Now, previously we did have the builders bonus program. That was a major tailwind behind us before. That has now finished. There are still projects that are rolling out because that were activated at that time, and people are still building that, but that is basically running out. So we're basically flatlining with regards to government grants side of things, but infrastructure projects is a tailwind. Government grants is just a sideways. And then we've always got the cash incentives and bonuses that are there always infinitum, the first homeowners grants, which slightly change from every single state, but know that they are always there. So if we start to look at that with regards to those, for the next 6 to 12 months from an infrastructure projects, tailwind, okay, that is helping us massively move forward. The cash incentives side of things, that is a sideways movements for the next 6 months or so. And I'm predicting, even though nothing has been announced, I'm predicting the fact that because of the fact that our building incentives actually run out, all the building is about to come to an end. There's a lot of builders who are starting to cry out. So the HIA, the master builders, that sort of thing, they're starting to cry out to say, hey guys, because of the cost of construction and that sort of thing, our market is actually starting to struggle. And I'm seeing a lot of lobbying from master builders and HIA and property council all saying, hey, government, you need to step in and actually start to think about what we can actually do in the short to medium term to sustain that industry. So watch out. I'm predicting maybe an additional tailwind coming from a cash incentives program with regards to more bonuses for the construction industry in the not too distant future. Now, it's not for real, right now, it's my speculation that that will actually occur. Now, the next one, population growth. Now, our population growth, folks, we've got a number of different variables that actually go into that. So we've got intrastate, so that is people moving from the city out to the regions. We've got from the regions back into the city. We've got interstate, so people moving from Sydney to Brisbane or from Melbourne to Perth or whatever those is. Then we've got births, deaths, and marriages, and then we've got international migration. Now, when we start to look at all of those, during COVID, there was a heck of a lot of movements out of the city. So if you were in Sydney or Melbourne in particular, there was a lot of people who had been trapped and locked up for quite some time who went, I don't like this, I'm out of here. And they started to move out to the regional areas. And so there was a mini boom in the regions that actually started to occur because of that. So if you were in Sydney, that would be a headwind because people are leaving. If you're in the regions, that would be a tailwind because people are moving in. So that in itself, I guess, created a market within a market, depending upon where you are physically sitting. Interstate, similar things were starting to happen. Queensland was not locked down. Sydney and Victoria in particular were locked down. And so whenever there was an opportunity to open up the borders, there were people flocking out and over the borders out the wazoo quite a bit. So WA and Queensland tended to be the destination that everyone has actually run to. So again, if you were in Melbourne and if you were in Sydney, they were headwinds for you. In the regions, in Queensland and Victoria, they were tailwinds. Now that is still the case. However, that's starting to soften off. Okay, it's not starting to have the impact anymore because our borders aren't locked down anymore. We're no longer having these I guess, snap lockdowns in all our areas. And we're actually getting back to a relative normality. And so everyone's saying, well, I don't need to run away anymore. I can actually live where I was living. And so I think that that movement is going to start to plateau and start to move sideways again for the next little while. Now, the major population growth, though, however, is international migration, so overseas migration. Of course, that stopped massively when we locked the borders. So we were seeing anywhere between 200 to 300,000 people coming in per year previously internationally, and that dropped to, I guess, a negative where we actually had people fleeing the country as opposed to running into the country. And so we went into a negative population growth type period for a small little while there. Now, the borders are back open and people are starting to come back. But when we start to look at the numbers that are starting to come back, so let's have a look at this. We can start to see that we've got our net overseas migration starting to come back. Now, we're somewhere around this 30,000 people mark coming back in, but we are nowhere near the peaks that we were previously. And so this giant drop-off was all of COVID, folks. So what this is telling me is our population growth is coming back, but it hasn't hit yet, but it's coming next. Okay, so this is giving some more demand on the amount of stock that we have right now. So right this very moment, that demand is relatively weak by comparison, but it's going to get back to higher levels in the not too distant future. So as we start to look ahead, that is going to be massive, massive tailwinds behind us to say, hey, this demand is going to come in and need to buy product in the not too distant future. So we need to be starting to create the product for that. So as we start to see those migrations start to come into play, if I look at intrastate, I'm going to say that's a sideways movement. If we talk about interstate, well, it depends. Are you in Sydney and Melbourne, in which case it's a headwind. If you're in Brisbane or Perth, then it's a tailwind, okay? And if you're thinking about international migration, that is very much a tailwind starting to become behind us. So I think you're starting to see, we're starting to build a couple of tailwinds coming up for us. Now, that's really good to know because I guess, and I'll want to point this out really clearly. I should have pointed it right at the start, but what happened with COVID was very, very counter-cyclical. So we have normal market movements that happen all the time, but COVID was this artificial movement. So our fundamentals got smashed. So our fundamentals were strong and that we actually had a fairly reasonable market, but the other things were actually working against us. And so then straight away afterwards, we had to spontaneously recover from that. And we had artificial recovery based on artificial government spending. And so the last 12 to 24 months of our market is not our normal market movements. So what we're starting to do is we're starting to return to the fundamentals that are actually sitting underneath the market in the first place. And it's just going to take us some time to ebb back into that. So let's start to look at supply and demand. So supply and demand, folks, there's three stages to this. So there's the development approval side of things. Then that is the potential for, I guess, stock to actually be created. Then there's the building approval, which is, hey, that council development approval has now actually been turned into, hey, I've got an engineered level drawing. And then you've got the finance approvals to say, well, are people actually buying the stock? Now, when we start to look at this, we go back before COVID and we look at the market cycle that was happening at the time, and our market was already starting to be depressed. So if we go back to June 2018, we could actually see the number of development approvals was dropping quite significantly. And that was just because of normal market movements, normal market cycles, because what you'll find in any market is, look, as the buoyancy of the market happens, there's a thing called the arbitrage. We need to buy at a certain price and sell at a different price, and the difference between those needs to make sense. And if the market is going against us, then it doesn't make sense for developers to actually go and develop. And so what you'll find is that there will be times when development approvals just won't happen because people can't afford to buy the property and wait for a market to actually happen. So that was happening back in 2018. Then that started to take hold for a good year or two, and the number of development approvals started to go down, 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 down. Then COVID happened. Now, when COVID happened, we were already at the bottom of a depressive cycle from the number of development approvals perspective. Then COVID happened, and everyone was predicting the property markets were going to drop anywhere from 20 to 30%, and the sky is falling and all that sort of stuff. So, of course, there were no development approvals going in at that point because nobody wanted to buy into a market that they didn't know where the bottom was. And so we've got a period of a good 3 years, folks, a good 3 years that were 2 years of genuine market movement. And then I guess about probably 18 months of COVID type environment where the number of development approvals coming through was way, way, way lower than would typically come through. Okay, which means that there is a gap. There is a giant gap in the amount of potential supply that is going to be available in the market at any one point in time. That bubble is rippling through our economy right now, and it's waiting to actually get to the point where it actually impacts us, and that's about to happen. Okay, now straight after that, government started printing money. They started doing a whole bunch of building bonuses and that sort of thing. And then everything started to be attractive. The market kind of kick-started really fast, and the mini boom started to happen. And at that point, everybody got in and said, we need to do development approvals. We need to do development approvals. And so there's an oversupply of development approvals that actually started to come in. Then it got to the point where, hey, the cost of construction is going up. The market is getting ridiculous. It started to get overly again, and then it started to drop off. So if we actually start to look at this visually, you can actually see this little period here. This is where the market was already depressed before we actually started to come into COVID. Then COVID happened. This is the mini boom that we were talking about. And now we're started to lag off again, and we're starting to come back to an equilibrium. But what I'm saying is this area here, this is a window, folks, of undersupply that has not yet hit us. And then when this happened, whilst this is a whole bunch of development approvals that were happening at the same time, it was being consumed as quick as it could actually be created by the amount of constructions that were actually happening. So development approval would happen and a building approval would snap it up straight away. So we've got this giant pocket here, where we just don't, this undersupply of stock that's actually going to start to hit us in the not too distant future. Now, we're not far enough into this cycle here, but we can actually see that we're coming into a depressive cycle here. And that's, again, because of the fact that we've got all the challenges with regards to the current market and interest rates and that sort of thing, and the property prices going down. Nobody wants to get into a market where it's going super down. So what that's telling me is there is a lack of supply. Now, a lack of supply by itself, it doesn't mean a huge amount, but a lack of supply with an increase in demand starts to then mean, whoa, hang on, folks, people are going to start to be fighting and clamoring for this stock. Now, remember, the demand is likely to come with the population growth. So that as the population growth starts to kick in, that undersupply, the two are going to hit each other, and that's going to cause a second kick in the market, folks. And this is where the true fundamentals are going to start to kick in, right? Whereas before we had these artificial ones. So as we start to think this through, I guess when we start to look at the number of building approvals that we actually had, you can see that we had a massive peak here in building approvals. That basically all came from the building bonus side of things. Now, each one of these building approvals will take, depending upon what it is that's being constructed, anywhere from 6 to 12 months to construct. So this building approval that was started here, for example, would be finishing all the way out here sometime. So you can see here is a distinct trend line down to say there isn't much building actually being commenced at the moment. So building commencements are way, way down. What that means, folks, building commencements down means that pretty soon all those jobs are going to finish, and then every single builder is going to be hunting around, looking around, going, hey, where's the jobs? Now, because the property market is coming down, then everyone's saying, well, there's no jobs, no building commencements actually starting to happen. And there's no supply to actually sit there. So builders are going to be starting to twiddle their thumb. The tradies are going to start to be twiddling their thumbs, and they're going to start to get super hungry for work. What that means is that they're going to start to get very competitive on their labor prices. Now, right now, they've not had to be competitive on the labor prices because the demand was so high that everyone said, well, if you want to employ me as a chippy, there's no other chippies around. You need to pay my rate. And so labor prices have been going up and up and up and up. I think that in the not too distant future, the labor prices are going to start to come down by comparison. Now, that is going to be somewhat mitigated with wage growth, which I'll talk to separately in a sec. But what we're going to start to see is, at least from the labor perspective, construction costs starting to soften. Now, it is nowhere near going to drop to the previous lows that we were before. So we had nearly 20% rise in prices for construction over the last 12 months or so. We are not going to have a drop that is as large as 20%. That I'm not telling you that that's the case, but we will definitely see a softening. I don't think we're going to see the continual escalation from a labor perspective in that side of things. What we will have, though, is so home loan approvals obviously rocketed as well because of all those building approvals during the business bonus. So I forgot to mention that. What we will have, however, from a construction cost perspective, is the cost of materials are starting to come down. Now, they're only just softening. So the three ones that are largely impacting everyone is steel, timber, and concrete. Okay, so they're the ones that are the biggest influence, but there's a whole bunch of other materials that are happening that have been caused largely by a lot of global supply chain issues. So we had a lot of challenges that actually hit us coming into COVID. Every time a place was actually locked down, so let's just say that Western Australia was locked down. No, that's probably a bad example. Let's just say that where the mining stuff was being extracted out of the ground was being locked down. To getting onto a ship was getting locked down. So there's a delay in getting it out of the port. When it got to the other end, the refinery that was actually going to deal with that raw material, they also had a lockdown, so that had a knock-on effect. The next one down the process, they take that to someone who's going to turn that steel into, a steel frame. That then also had a lockdown implication. So they had this knock-on effect of every time there was a small little lockdown one place, it had this domino effect into the next one. What that caused is a concertina in our global supply chain issue, which caused massive, massive problems. Now, you will relate to this. You'll know that when a car crash happens on the highway, the car crash has been cleaned up, but for hours afterwards, everybody slows down for where the crash used to be. So there's this ghost of a problem that actually sits there for a long time after the actual accident has actually cleared up. So our accident has gone, the COVID has gone, but the knock-on effect in people trying to catch up still hasn't quite got there. But it's starting to, which means that all of our cost of our shipping containers and that sort of thing is starting to come down. The delays in the materials actually being manufactured is starting to come down. Now it's going to take some time to actually roll that out. There's probably another 6 to 12 months of softening that's going to happen in all of that. But if we start to have a look at just something as simple as, I guess, the shipping container prices, you can see where we were all the way back in 2021. You can see the cost of shipping containers has come way, but way, way, way down. Remember, that was also impacted by the fact that we had the Suez Canal incident where we had I can't remember the name of the ship that got trapped in there, and that in itself caused problems as well. Now, interestingly enough, when we start to look at I guess the forecasts with regards to construction, the Housing Industry Association has said, look, they see a softening in the number of construction commencements for houses, but they see an increase in the number of construction commences for apartments and townhouses. So we can see the increase in units and townhouses and a decrease in housing coming from these HIA stats. Now, these haven't been updated for about 6 months. We're expecting a new set of stats to be coming out any tick of the clock now. And if and when they come out, I will update you guys accordingly. But this was, I guess, a little while ago, but we're expecting those updates now. But the reason why they're predicting an uptake in the apartments is because what's actually occurred is all the building bonus was for brand new houses. And so what it did, it created a boom in the house price, but you didn't see the boom in the apartment price. So the apartments and the townhouses, we've got this gap in between. So the house price went up, but the apartment prices didn't. So this gap is the widest gap that it's actually been for quite some time, and in some instances as high as 28%, whereas typically it's somewhere between 10 and 15%. So what they're expecting to see is, look, apartments and townhouses are going to become a little bit more affordable, and so as we start to commence that, they're going to start to close the gap. And so they're seeing, as the demand starts to come in, people are going to get the more affordable stock. That's then going to create more and more demand on that, and then it's going to start to rise. That's basically what they're predicting. So that means that all the people coming back from a population side of things, as they come back from international migration, units and townhouses are looking quite attractive to them. Now, what's interesting here is that there's a whole bunch of media stories now starting to say, look, the cost of the building cost inflation is set to actually ease for the next little while. It's going to start to soften for all the reasons that I've actually touched on. It's going to take some time, folks. And I don't think it's going to come back the 20% that it was. It might come back 5. If we're really lucky, it might come back 10. I don't think it's going to come back 10. I think it's probably just going to soften to about 5, but it's going to become more predictable. And that's probably the key that we're all looking for, is the predictability of the price points. Whereas up until now, it's been every month there's another increase and another increase and another increase. Almost a lot of builders were actually struggling because they gave fixed price contracts, but every month when they went to go buy the materials just kept going up and up and up. So a lot of builders actually got into a little bit of financial difficulty in going through those stages, which is another reason why the Housing Industry Association, the Master Builders Association, are lobbying governments to say, hey, our construction industry is actually struggling here. You need to actually help us out. So when I start to look at these from an assessment point of view, I see from a development approvals perspective, I see not many development approvals for the next little while, at least 6 months, but in 12 months' time, when we start to hit the bottom of this market, then I start to see that we're going to start to get development approvals again, because developers are going to start to see great buying opportunities as we're at the bottom of the market. Buy low, sell high. They're going to start to kick in and do a lot more development approvals in the not too distant future. Building approvals, I don't see many more building approvals happening in the next little while, again, because the cost of construction has been so challenging, and again because of the fact that we've got I guess a dropping market, no more government incentives. So again, that's flat for the next little while for the building approvals. But once we hit the bottom of the market, what I think we're going to see is a disparity between, and I've not touched on this yet, a disparity between the amount of rent that people are paying and the amount it's actually going to cost them from an interest rate perspective, because rents have been going up and up and up as well. And so I'm going to start to predict that people are going to go, do you know what? It's as cheap to actually buy as it is to rent at the moment. So I think we're going to start to see a few more building approvals. So that's going to be a tailwind. That's in 12 months, maybe a little bit further on. Finance approvals, I think, are going to be relatively flat. So overall, for the next 6 months, flat across the board. And when we get to 12 months mark, I see a tailwind for our development approvals and building approvals. Lastly, our purchasing power. Now, our purchasing power is really coming down to, look, can we actually afford to buy, I guess, these dwellings in the first place? Now, there's a few factors that come in here. And so obviously, inflation is running super high at the moment and predicted to get to 7.7% by the end of the year, according to the RBA. The RBA have been for many, many years trying to run a finance policy that actually keeps us at an inflation target of somewhere between 2 and 3%. That is deemed to be a healthy range that allows the economy to grow, but doesn't keep the cost of things going up out of reach of normal everyday wage growth. So that's that RBA policy started all the way back in 1992 and has been doing quite well for many, many years, until about the 2016 mark, where inflation started to go really, really low, which is why interest rates went down, because they were trying to kickstart our economy and kick us off, and they were struggling to kickstart it. The problem is now inflation has triggered. That's triggered very, very hard in very, very quick succession. So if we look at the inflation rates at the moment, you can see this is where we were under that band before, and now we've rocketed through, and they're predicting it's going to get to 7.7 by the end of the year. Now, that's why we're ratcheting pretty hard on the interest rates at the moment, is to try to slow that inflation down. Now, a lot of that inflation is caused by the rising cost of houses. It's also caused by the rising cost of construction, fuel, a number of things like that, all of which are called like the global supply chain challenges. So as our global supply chain challenges start to normalize, that's going to start to come back into range. So the RBA has said, look, guys, we need to slow you down, absolutely, but we don't need to yank on the handbrake. What we need to do is we need to put a gradual slowdown on the handbrake. They have predicted, the RBA, every time they do a rate announcement, what they do is what they call a forward projection. So the forward projection is where they talk about, look, this is what we expect in the not too distant future with regards to future rate rises. That behavior is very deliberate by the RBA, because what they want you to do, they want you to start to think about, hey, what's going to come next? And they want you to start to modify your behavior before they actually have to pull on the handle. So if you start modifying your behavior all by yourself, they don't need to do anything. So they're predicting at least another rate rise and potentially a second one by the end of the year. Now, that's not the language they use. They use a little bit fluffier language, but they're basically saying we will do whatever it takes to actually bring inflation back under control, including interest rate rises, which is them basically going, we're prepared to do it and we will do it. So watch out. You better curb your behavior now. And if you do that, and if you're a good person, then we will reward you by not lifting our interest rates too high. So that said, every time we've come into periods just like this, when we look historically, there have been somewhere between 6 and 7 interest rate rises in a row has been the trend that's happened every time we've come into little bursts of inflation just like this. We're on our 4th one, so I'm predicting if statistics are still working for us, there's at least 1 to go, probably 2. That will keep us within the averages range. The RBA is saying, look, if they can ratchet it by the end of the year, peaking at 7.7, inflation should come back to normal in about 18 months to 2 years. Okay, so they're trying to bring that back into range slowly. They want to bring us in for a soft landing, not a hard landing. Now, if they do that, then we're all going to be able to manage everything. And what they know, because they have the tentacles that go in through the ATO and into our bank accounts, they have the tentacles to see what our savings rates are. So they can actually see when we're saving, when we're spending, how much we're putting against a mortgage, how much we're not. And what they're seeing is, look, we have been squirreling away money for the last little while because of the fact that we've had these turbulent markets. Whenever there's a turbulent market, people don't spend. So there's a whole bunch of nest egg that most of us have actually got squirreled under the mattress or sitting against a mortgage offset that they know that they can actually tap into, that we can afford the hurt in the short term in order for the better long-term gain. So that's kind of where they're sitting at the moment. So interest rates, I'm going to predict at least 2 more in the next little while. Unemployment rates, we are at rock bottom. Unemployment rates, we have not been this low for eons, folks, which means that everyone has a job. That's a great, now, not absolutely everyone, but it's you can see very clearly our unemployment rate very, very low. So if everyone's got a job, then it's not that we aren't getting paid. What is it? Are we getting paid enough? And so that wage growth is probably the big thing that's actually hurting us at the moment from an affordability perspective. Now, if we look here, this is what I was talking about before. Have we been squirreling stuff away? We went through a massive spike where we were saving money when the economy was struggling. We were saving, and we started saving again. So they know that we've got a whole bunch of nest eggs sitting there, folks, that they're more than happy to spend on our behalf with regards to these interest rate rises. Okay. So wage growth and wage growth expectations, we can actually see here that wage growth has been quite low for quite some time. It's kind of trending down. We're trying to bring it back up to some normalization rates. They know that if inflation gets up, so long as wage growth follows it, things will still be affordable. So one of the reasons for the interest rate rises is to trigger wage growth. Okay, if they can do that, then inflation will not actually hurt us in the pocket as much as it seems like with regards to the graphs. Okay, so if we get paid more, we can afford to pay more. That's basically the gist of it. So the wage growth has to catch up. Being that we now have a Labor government, they are going to do everything humanly possible to create wage growth. The Liberal government were very anti-wage growth. So the Labor government are going to be very pro-wage growth. So watch this space with regards to the wage growth. Those things are going to start to marry up in the not too distant future. And this is the one I was talking about before with regards to rent. You can actually see in Sydney, you can see the advertised rent rates have rocketed through the charts. In Melbourne, same thing, rocketing. In Brisbane, same thing. Perth is the only place where it's actually started to go backwards. What all of that is telling me is that, look, the cost of rent's going up, 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 up. But if we get our inflation back under control, it's actually going to potentially be cheaper to start to buy a house again in the not too distant future. So as those gaps start to widen, buying a house or buying an apartment is going to start to become super critical. Super affordable, even despite interest rates, folks. Even despite interest rates. So the RBA have predicted, I guess, as I said, that their forward projections. I'm not going to read all of this, but I will read the bits in bold that I've got out there. So this is an extract out of the RBA's announcement last month. They want to do further steps in normalization of monetary conditions. It has been required in order. So this has all been required in order to bring inflation back into target. The board expects to take further steps in the process of normalizing monetary conditions over the months ahead. That is them announcing, hey, we are going to do more interest rates. And then down the bottom, the board is committed to doing what is necessary to ensure inflation in Australia returns back to target over time. That is them basically yelling to the rooftops, hey folks, we're going to ratchet rates again. We're at least going to do it once, and we're probably going to do it twice. We're committed to do whatever it takes. And then they've gone on to then say, I guess, how long they think it's going to take to actually bring it into control. As I said, that is them trying to get us to start to modify our behaviors today. And if we do that, that's going to help massively with regards to them not needing to ratchet anywhere near as high. So when we start to look at all of that, obviously interest rates are then going to become a headwind into us for the next little while, with a few more interest rates coming. And then in 12 months' time, I think it's going to stabilize. It's going to flatten out, okay? Our unemployment rates, we've got record low unemployment rates. That's a tailwind. That's kind of pushing on our back and helping us forward. That's going to stay that way for quite some time. All those infrastructure projects are rolling out for years and years and years. Now, all of that said, the RBA has been very consistent with their policies, and I think they're going to be flatlining. So I don't see APRA doing much changes to any of their policies or anything, or other than interest rate changes for RBA. I think we're in a fairly flat cycle for all of those. So if I bring up my little map again, what that's telling me is, look, right now we're clearly in a down cycle. We've got more headwind than we've got tailwind. If we come to 6 months' time, we've got more of not much happening. So we're going to soften. The market's going to soften. This is if you are in Sydney and Melbourne. This is if you are in Brisbane and Perth. Okay, so people running out of those different regions. But what we can see is 1, 2, 3 genuine tailwinds. And 1 genuine headwind, and then I guess a flip-flop depending upon where you're located. So basically, the market's going to start to recover a little bit. Now, it's not going to rocket back, folks. It's just going to gently come back and start very ever so gently to ease. But look what happens in 12 months' time. Tailwind, 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 tailwind. Guys, we are coming into an opportunity because of the fact that our development approvals all the way back here, these black holes that are here, are basic, and the population growth that is sitting. Where's my population growth? International migration. These population growth things here, these two are working against each other. The lack of supply and the huge amounts of demand are basically the drivers that are going to kick us into gear, in my humble opinion. Remember, I'm not an economist. In my humble opinion, in the not too distant future, which means that right now, with the market softening, okay, and the market going backwards, now is the time to prepare, folks. Okay, we're coming into fantastic buying opportunities. That means that the cost of purchasing the property are coming down, and the demand is likely to kick on at the by the time we've actually run our project, remember, most of our projects are taking 18 months to 3 years to actually run. Majority of those are going to be hitting the upward swing right at the perfect time. If you are creating the right stock in the right place, and that is the key, if it's the right stock in the right place. So my question to you is, what are you doing to prepare? What are you doing to learn? How do I actually become a property developer? What are you learning? What are you doing about working out where is the right place to actually be doing these things? What research are you putting into it? The other key thing that I really want to lock in here, and I want to lock it in really, really hard, because we've just come off of this artificial boom, vendors' expectations and prices are still up here, even though the market is clearly dropping. The vendor wants to protect this price point, okay? But as we start to get less and less people in the market, their ability to do that starts to become lower and lower and lower. Now, in a booming market, they can just dictate terms. I want unconditional contracts irrespective. But in a softening market, we get to dictate terms. So we get to say, well, if you want this high price point, Mr. Vendor, then what I need from you is an extended settlement or a joint venture or an option contract or some form of long settlement terms that allow us to kick the costs of the holding costs. So the interest rates, the land taxes, the rates, all those sorts of things that are sitting there. We want all of those costs to be deferred to the tail end and effectively pass those back as savings back to the vendor. So even though the market says that they're down here, we can protect this price point by saying, well, all these holding costs that we could have had, rather than give that to the Commonwealth Bank, rather than give that to Office of State Revenue, rather than give that to, I guess, the council, rather than give that to all those different departments, why don't I give it to you instead, which then will just bump up the price, okay? So you're going to be able to get very, very good terms under what is called low or no money down. So the ability to extend, drag out, push out, sometimes defer, sometimes completely avoid some of the costs in the process to make your deals a lot more profitable. So folks, that's my view on where the market is in the not too distant future. I'm super keen to make sure that all of you actually are taking advantage. If you really, really want to know how to do that, why don't you come along to some of our monthly meetups? See if I can actually find the link for that for our events. Here's our events. So come to those monthly meetups around the country, and we can help you to actually understand what it actually takes to actually get into the process. And if you're super keen on, so that's just, I guess, a networking group that actually helps you to, I guess, have people of peers actually doing the things that you want to do sitting around you. If you're wanting to learn more formally on how to do that, then we do have our 12-month education and mentoring program that is called Property Development Formula. So if that is of interest, you can go and actually check this out here if you want to actually work out how to do that. Because in my humble opinion, we've got a good 6 months to prepare for where I think the bottom of the market is going to be. So you've got 6 months to learn your trade and actually get very good at what it is that you actually want to do. So that said, folks, I can see a couple of questions that are actually coming in. So let me see what I can see from a questions perspective. So these Sunday sessions, so the Unsportsman, I don't know who that is, sorry. These Sunday sessions are great work. Working my way through the back catalogue of Sunday sessions. Well done, thank you. 69, there's some people have hijacked my realm. I'm not going to read some of those out. They are not family-friendly comments, so I'm going to leave those alone. Folks, let me just jump onto Facebook itself and see if you guys have got any questions at all with regards to what it is that I have just been talking about. So give me 2 secs while I... Okay, a little bit of feedback there. My humble apologies. Okay, so Peter Trung says, "Hi, mate. Have you recovered?" Hey, Pete, how are you? For those who aren't aware, we had our 10th birthday celebrations for our Property Developer Network last night. Pete, I got home at 5 a.m., my friend, so I'm doing pretty good considering. Looking to do that again in Sydney next week and Melbourne the week after, mate. So make sure that you get yourself a leave pass. Johan says, "Amazing commentary, Rob. Backed by data and specialized knowledge. Thank you very much." Sorry, I don't know how to pronounce that. Simran says, "Hi, Rob. You have always said one council and 3 suburbs. How do you align this to your view on markets within the markets? My research has been on one council, but that may not necessarily be that particular market we are aiming for." It's probably a long answer to actually answer that. And it really comes back to really understanding what your development strategy is. That development strategy will inform where you should actually be going. That where is based on this evidence that I'm actually talking about. So where are all those infrastructure projects actually starting to activate areas? Then you start to look for evidence of success that other people have done what you want to do in exactly the place that you want to do it. Now you want to prove that they've actually done it, and you also want to prove that they've actually been profitable in doing it. So we have a thing that I teach inside our property development formula program called the suburb selection process, which actually goes and gathers a lot of that data for you and helps you to actually determine whether or not a suburb is actually whether it's got the potential to be activated or if it's actually been activated and is actually profitable at this point in time. Jazz says, "Awesome session. Thanks, Rob." Stuart says, "Hey, Rob, it's interesting that the gap between houses and townhouses units has grown and how that growth differential has increased since the Victoria stamp duty concessions for buying townhouse apartments off the plan have been removed." So Stu, mate, I'm not sure exactly about those concessions, so I will look into that. So interesting observation. So thank you for highlighting that to me, mate. But I don't think that those two are, I guess, that's a correlation, I would say, rather than a causation. So be very, very careful with correlation and causation. There are lots of things that I'll give you a perfect example. There was a study that actually had a look at the number of mobile phones that were actually in use over a 20-year period. And there was also a study that said the amount of brain cancers that were happening. And what happened is the brain cancers happened well in advance of the amount of mobile phones. So the argument is that mobile phones don't cause brain cancer, but brain cancer causes mobile phones. So that's correlation, whereas causation would have been, well, did it actually happen the other way around? And if so, is there scientific and empirical proof to prove that? Ekaterina says, "Can't wait until builders are forced to be more customer oriented." I think that might just be your particular builders, Ekaterina. I mean, as a general rule, they're humans. If we treat them well, they will generally treat us well. But I guess while there is so much demand on them, and they're all under a lot of financial stress at the moment, given the fact that they've had to do fixed price contracts, a lot of them are struggling, to be brutally honest. And so you're probably seeing the edges of people's, I guess, tolerance levels. So I certainly understand where you're actually coming from. Tamika says, "Smiley face and hugs and kisses." So thank you. Daniel says, "Super insightful and highly relevant property overview. Enjoy your market perspective, Rob. Thank you for sharing some of your Sunday sessions with us, or Sunday afternoon with us." You're welcome, mate. Tamika says, "Thank you." Bernard says, "Excellent analysis." Stewie says, "Thanks, Rob. Always appreciate your insight." Lots of people saying thank you. And Daniel has also done the link to my events page. So thank you, mate. Lots of people saying excellent job. Brooks says, "I have a 1 into 3 subdivision going through council at the moment that we are building 2 new builds when then selling. Should I be selling these DA approved now or build the 2 and sell once? Cheers." Brooke, I clearly can't give you advice on what it is that you should do on your circumstances when I don't know anything about your project. I don't know anything about your location or anything like that. What I would say is you need to be looking at the product that you are selling. So if it's a subdivision, you've got 3 ways of exiting that. There's vacant land, you've got house and land, and you've got a house. So you need to look at the three ways that you're actually exiting that and look at what is the price point that I'm getting for each of those by doing your suburb research. Now, if you know what that is and you're going to start to look at the demand on that, that's going to start to then give you the insights that you're looking for. Now, the challenge that I would say right now, if you try to sell as vacant land, Joe Public is seeing the exact same concerns that you and I are seeing with regards to the cost of construction costs right now. So Joe Public probably don't want to take on the risk of the construction costs actually blowing out. As property developers, we make money by solving problems for people. And so one of the problems we can solve is, why don't we build the home, solve the problem for them? Don't let them stress about the cost of the construction, and instead just give them the finished product, and they can say yes or no, I like it, and yes or no, I like it at that price. So you want to start to look at, well, what are those price points? Should I actually try to sell? What is the appetite for that particular product right now in this particular market? So if there's a lot of demand for vacant land right now, sell it, right? Absolutely, cash in, get the risk off the table, do that sort of thing. If not, then perhaps consider going all the way through the construction process. Hope that helps. Hasram says, question regarding rapid elimination method. I get the what, but I'm unsure of how. For example, is the property developable? How do I work that out? I'm a first-time developer looking to do my first project. Hasram, I think just based on your question, you've probably got a little bit more learning to go before you actually want to get into the project. So I'll just kind of throw that out there to say, look, don't be in a rush, okay? But the how, you want to get really, really good at your site assessment process. That is the area that most people fail dismally at. Because they think that a feasibility is just a spreadsheet, right? But it's not. A feasibility is the ability to assess a site and identify every single issue, challenge, and problem that you're actually going to have on the project, and put a line item with a cost associated with it in your spreadsheet. So if you don't do a good site assessment, then you're going to completely miss the problem. So it won't make it into the spreadsheet. Spreadsheet's going to look fantastic. It'll look highly profitable. But when you go to run the project, the problem will always be there. So you want to get super good at your site assessment. So I think if you concentrate on that in particular, get to become an expert in the particular products that you're trying to create, an expert in the area that you're trying to create, you'll start to understand all your cost points that actually go into that. So hoping that helps, mate. Otherwise, I guess come along to one of our monthly meetups, come to the masterminding process, throw your problem into the ring in there, and we'll more than happily, so the link for that is on the events page down below. We'll more than happily try and help you with guidance on any one particular site that you're looking at in that masterminding type process, or alternatively, there is our property development formula program if that's of interest. So Mark says, advice, thank you. That's greatly appreciated. Wahid says, hi Rob, thank you for today. Can we get any material from last Saturday's events, as I missed the event? Unfortunately, Wahid, the answer to that is no. That is very, very deliberate, because we want people to actually turn up to the event and attend the entire session, because it was given as an end-to-end type solution. So no, unfortunately, we don't release any of that. And there were some special things that we did give away just to the people that did attend. That said, we will run them again. So I tend to run them every 4 to 6 months. So watch out for the next one coming up. So probably somewhere around the February mark would be my prediction, Wahid. So otherwise, I guess that's one of the reasons why I'm doing this particular session here, because this is probably the biggest tidbits that people are actually asking for, is that market update. Matthew says, hey Rob, what's the website for Deal Exchange? Development.sites. So folks, I'm just going to reply to that one. Development.site, I should say. So that is a brand spanking new business that we have started. Basically, because we've got the largest network of property developers in the country, we have a ton of people come to us to say, hey, I've got this deal and I've got no one to buy it off me. And we get another ton of people who come to us and say, hey, I'm looking for deals. So we've built a business called Development Sites Australia. Their website is development.site. and you can subscribe there to say, look, I'm interested in these particular deals, and we will try to assist you in, I guess, being the glue between the person who has the deal and you who is actually hunting for the deal. So hoping that helps. Leslie says, amazing, Rob. Thank you. Glad I didn't miss this one. You're more than welcome. Khalil says, do you think it's time to buy now or wait to 6 to 12 months for duplex developments? Thank you for your education you provide. Again, Khalil, I can't give you advice. I'm not legally allowed to give you advice. All I can do is give you my read on the market. There will always be deals in any market, up, down, or sideways. As property developers, we can make money anytime. But there are always going to be challenges, and there's going to be headwinds and tailwinds. So right now, we've got some headwinds, but it's about to be massive tailwinds. So those tailwinds are going to help us to do what it is. The best time, if money was no object, if time was no object, if I could just sit here on my hands and just wait for things to actually happen, then in about 6 months' time, maybe 12 months' time, I'm going to say that's when we're going to be at the ebb of the market drop. Okay, now it might take some time to actually turn around, but we can start to see that all the drivers are starting to push at that point to lift us. Now, will it take 6 months, 12 months for that to kick in? I'm not 100% sure yet, but we can see that the drivers are starting to push. So for me personally, I'm trying to keep, unless the deal is a cracking deal right this very second, for me personally, I'm trying to keep a little bit of my powder dry, knowing that those deals are coming, but I'm not going to ignore a gift horse. So that if it actually comes and looks at me, I will more than happily jump on a deal right now if the deal makes sense. So hope that helps. Brooke says, does help. Thank you. You're more than welcome. Mark says, I do think you have not allowed enough time for the energy costs rising on household costs and the affordability factor. So Mark, there's a billion things that I could actually go into, given that we've only got a limited amount of time. I guess I've tried to, give us a high level overview. We could go into days of commentary on a whole bunch of stuff. What you've said is very valid. There's also what's happening in international markets and wars and, all sorts of things like that. So all of that definitely has an impact. What I'm trying to do is simplify it so that you guys can actually absorb the content in a very palatable way. So take your commentary on board, and hopefully everyone else has got something out of that. So Joseph says, hey, Joey, how are you, mate? Hi, Rob. Thanks for the great session. I heard you have a place where I can put in touch with potential deals. Is this online? Is that true? Yes, Joseph, that is Development Sites Australia. I will actually put that link up again in a moment. So folks, that looks like it. That looks like all the questions having come through. So thank you very much for your time. It has been an absolute pleasure as always. And I guess until next week, I will see you at the next meetup, which is in Sydney, which again is celebrating our 10th birthday, folks. If you are in Sydney, please come along to that on the 27th. Click on the links below with the events page. The Brisbane event last night was an absolute cracker, and the Melbourne one will be on the 3rd of next month. So those things are going to go off like a firecracker. So folks, it has been an absolute pleasure. I can't wait to see you at the next meetup and the next one of these Sunday sessions. Till then, bye for now.